Thanks for hanging out with us, traders and investors. We have Chris Martenson on the line. He's an economic researcher, futurist, and the co-founder of Peak Prosperity. Chris, thanks so much for joining us this morning.
It's my pleasure, Brianna.
So the first thing I wanted to ask you real quick before we jump into the Fed and into oil is what I was just talking about. Can you explain to myself and our audience what it means to be a futurist?
Yeah, it means being wrong all the time.
Oh, no.
It's a lonely business, but actually a lot of what I do is not anything more complicated than trend extrapolation. There are certain predictions that we can make which are going to play out unless something really drastic changes. So, for example, Japan is losing population starting at 2008, and they are on a downward trajectory. There's nothing that's going to change that in their population dynamics, so we can easily predict that the debt per capita is going to go up. Their attempts to stimulate their economy are going to fail because they're fighting a demographic trend. And until you understand and put that into play, it's hard to understand what's happening, but that's what Futurist does. It's really just putting into position the big trends, seeing where they're taking us, using that as a guidepost.
So using a lot of data to figure out what will happen in the future.
Yes, correct.
Okay, very cool. All right, so we're anxiously awaiting, or should I say patiently, awaiting to hear Janet Yellen give us a Fed announcement later today. What are your thoughts ahead of that?
Well, the whole of the bond and equity markets across the globe now are hinged on whether or not she's going to use the word patient or drop it or modify it or break out the thesaurus and find some other rhetorical device. It's really a tempest in a teapot. The bottom line is that the Federal Reserve and other central banks have been printing and been extraordinarily accommodative, and for whatever sets of reasons, the world economy has not gone roaring off as they hoped, needed, or expected. So I see this as potentially creating quite a lot of short-term volatility, but not changing the larger story.
Do you think investors are hanging on too closely to every word that the Fed says? I mean, there's this whole hoopla over one word, patient.
I know. And as long as we put quotes around the word investors, I would agree with that. Most of these quote unquote investors are now computer algorithms that have semantic sniffing algorithms, and they're looking to parse the statement in microseconds, if not, maybe a few hundred milliseconds, but very quickly. And then they're going to make aggressive moves based on that. So really, it's a whole new world out there. It started changing in 2008. The whole market structure is now dominated by computers and their lightning fast responses. So it's always interesting. You get fireworks, but I'm not sure. I think it takes days, weeks to find out what true investors really think.
Do you think we can expect an interest rate hike this year?
I think that the Fed has to politically because they've committed to it, but it's going to be very difficult. The dollar is way too strong to consider strengthening further through an interest rate hike. And I know that U.S. manufacturers are already crying foul over all of this. There is a large currency war going on. Japan is winning that. The euro and Europe are winning that battle right now. A strong dollar is good, but too strong is not that good. So everything has to stay in relative balance, and I don't see how the Fed can raise rates if it's going to really drive the dollar higher.
Okay, let's go into the oil market. And, you weren't real optimistic when we had you on a few weeks ago. Now we made a new low for the move at 42.05. Anything going to change this downtrend in the crude oil market?
Not for a while, because there's a couple of dynamics. A lot of people are looking at the supply side of the story. This low for oil is telling us that we have to look at the demand side. The demand just isn't there. The most frightening statistic people should be aware of came out yesterday was that for the fifth month in a row, Chinese house prices fell. The China housing boom has been a huge driver of all sorts of commodities and commodity complex pieces, including the economic strength of China and oil, very closely linked. So I'm seeing weak demand for oil. On the supply side, again, nothing optimistic. What's been happening is all of these shale companies are continuing to drill, not as fast as they used to, but they're drilling but not completing the holes that they've drilled. What this means is that the instant oil rises to a price that they feel supports the completion process, they can just bring new demand on like that. So there's a lot of things that, new supply on. So we're looking at lots of places where new supply could come on. People are worried in the trading business now about the possibility of Iran's sanctions being lifted, and Iran could instantly bring another 1 million barrels per day to the market. if they just lifted the sanctions. So there's a lot of supply that we can look at, but the big part of the story is demand isn't there. I'm looking for additional weakness.
On the first part of the show, Dennis posed a question to me, and I really didn't have a good answer, and hopefully we can get it out of you. A couple stocks like Chevron and ExxonMobil, I mean, they're still going down, but, certainly with not the same pace they did when oil was coming down through 80 and 70 and 60 and 50. Do you have any reason why a stock like Chevron or ExxonMobil, two of the big boys, are holding up here as opposed to breaking down along with the price of oil?
Well, I'm looking at it's just the general elevation of the overall market structure. People don't have a good place to find high dividend yielding stocks or bonds of any sort. So people are looking for yield. The big majors have decent yield. When they came down, they're offering, I think, what's compelling yield in this environment. Trust me, if interest rates started to rise or we started to see other market weakness, we'd see these sell off again because they don't have a compelling story. 2014, the majors turned in the worst year for oil replacement reserve and discoveries since possibly 1954, certainly since the mid-90s. Depends. We're going to have to see how the data sorts out. So they spent a lot. They found very little. Now they're just cutting to the bone. Investors are a little cheered by that. But honestly, people need to look a couple years down the road because they're cutting way past the fat into this story. They're cutting their future ability to replace reserves and pump more oil.
And Dan, I don't think, or not Dan, I'm sorry, Chris, we haven't talked about your video seminar that really took off and brought a lot of prominence to you, the crash course. Could you tell us about that in 2011, and are you going to do a follow-up?
Well, absolutely. We've just recently updated the whole crash course that finished in late 2014, I guess. So it's all updated at this point, the video series. We've got an accelerated crash course, which condenses the whole thing down to a really tight package, too, for people who are short on time. But what it does, I think that we can't just look at the economy anymore. It's insufficient to look at what's happening with money printing, monetary policy, earnings, all of that. We have to widen our lens to include energy as a prime story, particularly oil energy. We are not growing oil supplies at the same rate we used to. When we do get demand, we get very expensive oil, which starts to kill economic growth. So once you get those two pieces together, this is where the futurist starts to come in. You can start to make predictions. And then there's a third E in this story, which is the environment, which now means both the waste streams we're putting in, but the things we're taking out. That includes water, soil, non-renewable resources, copper, tin, bauxite, all these elements. There's a very big story right here, right now, which boils down to this. Our economy wants perpetual growth. We're running into headwinds, which I think will soon become brick walls on some key commodity cycles. And particularly, just look at water in California right now. There's a prime example of a really major problem brewing. Investors need to know about it. Citizens, individuals, it's a big story.
Water in California?
Yeah.
Oh, tell us a little bit more about that.
Well, they've obviously been under drought. Everybody knows that. The snowpack that's sitting in the Sierras, that's sort of like their battery, if you will, that delivers water to them through the dry season. Here they are approaching the end of their alleged rainy season, and the snowpack is sitting at 27% of normal and feeding into reservoirs that are at fractions of where they need to be. Already we've seen farmers all throughout the Central Valley get their water rights cut to zero at worst, and sometimes just 20% at best, for water that would be delivered out of aqueducts and other distribution methods. So look for big distress in the farming sector. We're looking at very, very possible shortages and price hikes for everything, vegetables, almonds, you name it. It's a pretty big deal right now. That's the sort of thing that, honestly, people could have noted and looked at and saw coming well in advance, and that's the kind of thing that we like to focus on at Peak Prosperity.
Okay, we have been on the line with Chris Martenson. He's an economic researcher and futurist, and
before we let you go, Chris, we've only got a couple minutes left. I'd love to turn our attention across the pond. ECB just started quantitative easing. I just saw a report this morning that there are riots at the European Central Bank in Germany because people are upset and blaming the ECB for ruining lives in the Eurozone. What's your thought on the Eurozone's economic situation right now?
Well, the Eurozone is obviously has a lot of difficulties baked into it. There's a fundamental North versus South divide, with the North being very productive, the South not have been as quite as productive. It's a real mashup, what the ECB is trying to oversee. So they've got a tough chore in front of them, but they've been making some of the same fundamental errors that I think our own Federal Reserve has made, which is that they're trying to protect one industry, and that's at the expense of everybody else. The industry they're protecting is the banking industry. They talk a lot, good talk about how they want the economy growing and employment levels, all this and that. But the truth is that when you unpack a quantitative easing program, it's simply designed to help repair bank balance sheets. And I understand why they're doing it. They're saying if we have a healthy banking system, then we can have a healthy economy. That's their model. Unfortunately, when you get into this distributive mindset where you're doing something like quantitative easing, you are by definition taking purchasing power from one group and handing it to another. Because here's a secret: you can't print real purchasing power out of thin air. When you print money, you take it from one place and you hand it to another. And so that's what the people are starting to get upset about. We're 6 years, 7 years into this experiment. Clearly, it's benefited the upper 1%. It's benefited the banking system, hasn't benefited the people. The people are being asked to pay for outsized gains and returns to one sector at their expense, and they're getting tired of it.
Okay, we have been on the line with Chris Martenson. He's an economic researcher and futurist, touching on a lot of different key issues here today. Chris, thanks for joining us. We hope to have you back on again soon.
Joel and Brianna, my pleasure.
Thanks, Chris.